Well, good evening, everyone. It's thank you for taking time this evening to join this webinar of HOOPP and your retirement strategy. My name is Rick Tomalty. I'm the managing partner with Caldwell Wealth and Estate Advisory in Kingston. And with me, I have two guests. Cara Chesney is a partner at MNP in Kingston, specializing in working with clients, helping them tax efficiencies, including, as you will find out in our conversation, some of the detail around staying compliant with HOOPP, how HOOPP interacts with your practice, with your corporation. And we also have with us Jake. Jake is off screen, and Jake is making all this technology happen. But the other thing he's going to do is that if you have questions as we go through our conversation this evening, feel free to use the chat function at the bottom of your Zoom screen. Jake will curate those, and our hope is we'll have about 20 minutes at about 7:40. We'll have 20 minutes or so to be able to address any questions that our attendees would have. So thank you for making this part of your day. We hope that you find this helpful. And I guess what I'd like to maybe start out with how this whole event got birthed. And back in December of 2024, the OMA sent out an email to its members informing them that they have been invited to join HOOPP, the Healthcare of Ontario Pension Plan. And within about 24 hours, I had two of my friends send me emails, both with the same message, both with the same request, saying, what's this about? What do I need to know about it? Is it for me? And our thought was, as a firm, we thought if we've got people reaching out that quickly, there are many others across the province for whom this also would be news and not quite sure what to do with it. So hence, we're together this evening to provide you with a bit of a broad overview of HOOPP, the invitation, how it works, how it might apply to your practice and your family. But one thing I would like to make sure is understood on behalf of both Cara and I is that we are not representatives or spokespeople for HOOPP. We're not endorsed by them. We're not paid by them. We're both here. Cara's here generously volunteering her time to this webinar as our firm is. And we are just people who deal with pensions a fair bit. Cara deals with pensions regularly, including HOOPP. And we feel we have some information, some insight that will be helpful to you in helping you make the decision as to what your next steps might be. Okay? Also, what I would say is that we're going to be talking about a number of things, and the topics, the things we talk about, they're not going to be regarding nothing we should say should be taken as a recommendation, other than perhaps to talk to your accountant or financial advisor. We don't know, we have no right to tell people what to do with their money or how to manage their money until we get to know them well. And so we're not offering recommendations, we're not offering advice specific to your decision to enroll in HOOPP or not. But we are providing context and providing some deeper understanding that is mostly available on the HOOPP website, but sometimes that can be buried in minutia detail, and this is designed as an overview. So with that, what we'd like to do is start by talking about why physicians might be interested in HOOPP and why now, and then talk about what HOOPP is and what role they play. And if we can just go back to that agenda, Jake, thank you. Who's it for? We'll talk about how you're eligible as a physician to join HOOPP and how it works, and could it be for you? And Then, about 7:40 or so, we anticipate that we would have some time for Q&A, unless we've done a terrific job of answering all of the possible questions in the course of our conversation. So let's get started with looking at the kind of the unique features of a career as a physician. And first of all, some of the people on this call may be well-established physicians. They might be mid-career or early career. Maybe you're in medical school. Maybe you're an office manager at a practice. For physicians, though, in general, Cara, you and I were talking about this in advance, that by the time you've done your undergrad degree, you've done medical school, you've completed residency, any specialty internships and so forth, you're often 30, 32 years old by the time you start. So, and your peers, when you went to undergrad, they got launched in their careers maybe 10 years earlier, 8 to 10 years earlier. And so typically physicians get started later in career, and the significant barriers to entry into the career go beyond the academic requirements, but you have to have some measure of financial, barring an exceptional case, financial resources available to you, whether through your own savings, household savings, or through loans. So what I see is many physicians getting started in the first number of years, they're saddled with a six-figure student line of credit. And so you come into a career, you get a late start, you have this convergence of large debt, desire to embark on a lifestyle that has been promised you through all the years of school, and you've deferred it, but it's calling you now. And you're also often at a stage of life where you're making, you're kind of transitioning from student to starting a family, buying your first house, those types of things, and you could end up with significant mortgage. Mm-hmm. And so you have that balancing, the challenge of balancing the tension between those three immediate things in front of you: mortgage, student debt, lifestyle, and then off in the distance over the horizon is retirement. And so the preparation for retirement often takes a back seat to some of these other more pressing issues. And then on top of this, whether you're working in a hospital or you're in a clinic where there's a number of staff and so forth, many of the people around you have one thing you don't have, and that is that they would be members of a pension plan often. And with that, they would have an assurance of a structured and predictable lifetime retirement benefit waiting for them at the end of their careers. Physicians to this point have not had that. And we were laughing about it prior to going on live, but so many people, Cara, you mentioned, will have a strategy for retirement, and it's not a very strong one. I'm going to save up money, and I hope to get to a certain amount of money, and I hope that that's going to be enough. Yeah. And we all need hope. It's very important to us, but it's a terrible retirement strategy. And so today is a day when we're going to kind of unpack an opportunity that may be of interest to you. So first of all, an introduction to HOOPP. We are not spokespeople for HOOPP, just so anybody from HOOPP happens to join this conversation kind of midway in. But the Healthcare of Ontario pension plan has been around for 60 years, 65 years. Started in 1960. It's well capitalized. It's got over $112 billion in assets, which just means that to meet all the promises of pension payouts, that it's got lined up in the future, it has 115% of the assets that it needs to meet those requirements. So very, very well funded, and 460,000 members. And again, it's just Ontario. So it's a large pension plan. And it is a kind of financial animal that is very rare to be seen in the wilds these days, and that's a defined benefit pension plan. Most pension plans, if you have one today, is defined contribution, which does not offer a predictable, certain lifetime income, but rather defined benefit pension plan provides a lifetime income that you can calculate today on the assumption of a few other variables. And we'll get into that detail in a few moments. And so so that's just as an introduction to HOOPP. So what does it take, first of all, to be qualified, to be eligible, to be a member of HOOPP? Well, first of all, with any pension plan, there are contributions from an employee and an employer. So with HOOPP, you have to have an employee and you have to have an employer. So that forces the first requirement, the first prerequisite of joining a HOOPP is that the physician has to be incorporated with a medicine professional corporation. In that way, we have an employer, which is your MPC, and we have an employee, which is you, the physician or the future physician. Also, there are some income requirements, and Cara, can you fill us in on those?
Yeah, so we were talking earlier with most of my clients, we do a schedule, right? So I work with my clients and they say I need X number of dollars every month, $8,000 a month after tax to live on. And then I work backwards from that and come up with, some salary and some dividends maybe built in there. And if you need extra and you want to do an RSP top up, maybe we give you a dividend. But we're kind of trying to build you some, and you have to have that conversation, I think, with your accountant. So you have to, do I want to have RSP room? Do I want to do CPP contributions? So all those factor into this decision. But if you want to join HOOPP, you will have to have a salary. You will have so dividends themselves are not eligible. You can't take all dividends and then contribute to HOOPP. You can still take some kind of split between the two, but you need to have a salary in order to participate in HOOPP. So if you've been all along not doing a salary because you want to do dividends, you're going to have to switch that model if you want to join. Yeah.
And the discussion that typically we would have with physicians who are incorporated is to kind of dance a fine line between dividends and salary, because in the big picture, there's not much difference from a taxation standpoint.
Right.
But as far as the money that lands in your pocket for cash flow in a given year, there is a difference between salary, which gets taxed at 100%. 100% inclusion, and dividends, which gets taxed at a lower rate.
Yeah.
So in addition to needing to be incorporated, needing to have salary as part of the compensation structure, you also have to practice in Ontario, because this is an Ontario-only pension plan, and the corporation, the medicine corporation, has to be a member of the Ontario Hospital Association.
So there's an annual cost to that.
Annual fee to that. Yeah. And finally, if your medicine professional corporation, your MPC, has employees that are not family members, those employees are also eligible to participate in the HOOPP pension, where otherwise they would not have been. And so that's a consideration. Is this just for you as the physician? Is it for if you have a staff that is employed directly by your MPC, you have to take that into account, that they would be eligible to join the plan. And there are some details on that for how future staff are treated,
Yeah.
how existing staff have the option to join later, but future staff have to
So-
participate and,
My understanding, so full-time staff that you hire in the future have to join.
right,
So it's not a choice. So there will be and we're going to show you the math on that shortly, but there's a cost to that. The employer has to pay a portion of their contributions.
right,
So there's a cost to doing that. I mean, I do, some of it is going to be a retention benefit, right? If you've got a staff that's now getting HOOPP, that I work with clients who do have, they have family health teams and their staff are all part of HOOPP. It is a good, in some cases, it's a good retention,
it's a way to keep your
attraction,
best
get people that,
Okay, so now the question is HOOPP membership right fit for you? Because we've determined whether or not you're eligible or can become eligible by opening an MPC. Just because you can join HOOPP isn't a slam dunk to say you should join HOOPP. And so there are a number of factors to be built into this decision. One of the early ones is, what's my runway to retirement? Am I, like the two physicians that contacted me, am I, towards the last 5 to 7 to 10 years of my practice or my career? Or am I a student? Am I just looking forward to getting to a point where I can become incorporated and get my career started? Well, those are two very different factors, same factor, two very different algorithms as to whether HOOPP is the right one for you. And Cara, you had a conversation with a HOOPP consultant, and they kind of gave you a sweet spot.
Yeah, so if you do join, there's an initial call with HOOPP. And so they're kind of saying around their guidelines is around 15 years is where it really does start to pay off. So if you've got a 15-year runway, we're going to talk a bit about buyback. So there will be a bit of an opportunity to buy. If you're at the end of your career, there may be an option to buy back some of those years as well. So again, I think it all comes down to, and we'll talk about it, but those last couple points, right, in terms of what is this a right fit for you? That it's not just an easy answer.
Right,
Yeah.
right. And you need some time to make the pension meaningful.
Yeah.
So, and Cara has spoken to that second point on the slide about the pension buyback, because if you're depending on your age, you have the option to be able potentially, as long as enough salary in your history, you have the option to go back and say, well, I've only started in this pension, but what would it cost to buy back 2 years, 5 years, 10 years to make it look as if I've been part of HOOPP for the last 10 years. And there'd be a price tag attached to that based on your age, the salary you've been drawing out of your corporation, and a number of different factors. There's also, in the consideration of whether joining HOOPP, there's a component of the decision that is not often spoken about, but very, very practical. And that's some of the financial obligations and the administrative requirements. And Cara, you have a lot of experience in helping companies, not necessarily MBCs, but helping companies manage their relationship with HOOPP. Can you tell us a little bit about what's required there? Yep.
So do you want to flip into so I think the key thing here is, this is the initial contribution calculation. This is how it works for her physician. So you're called a physician owner. If you're the physician who also owns the MPC, it's a physician owner. These rates are actually the same for staff you have as well. There's just some differences in the way they set what's called the baseline contribution. So there's a cost to you, right? So like anything, if you're doing a contribution into HOOPP, you're going to pay 6.9% of your salary up to what's called the YMPE, which is essentially the first CPP level, Canada pension level. That indexes every year, so it goes up a little bit every year. But using the 2025 number, it's 71,300. So the first 71,000 in salary you're going to pay 6.9% on, and then above that, you're going to pay 9.2%. And so that's really important to know that, that's going to come right off your gross salary. That's money that's going to go direct to HOOPP and not into your pocket. So it's your retirement savings that way. The MPC has to then contribute 126% of your contributions. So we've done a math calculation here just so you can see what it looks like. The key thing here is you're going to set a baseline salary with HOOPP. So that baseline salary is when you first sign and agree and say, I'm joining, that's the salary you decide is the number. that you want it to be based on. And so in this example, we're paying our physician $250,000 a year, but 130 is salary and 120 is dividends. If you set your baseline at 130, you're going to be, you can index every year that is the opportunity to index with CPP plus 1%. So you can increase it slightly, but you really can't go from 130 to, 500,000 or anything like that. You can do it, but you won't be doing HOOPP contributions on it. So there's a baseline you have to work within every year. So when you're doing that, it's very, very important to set that at the number that makes the most financial sense for you. So in this example, this physician's taking 130,000 in salary. They're going to contribute on the first level, 4919, on the second level, 5,400. So the physician will contribute 10,320. That comes off the 130. So 130 minus your CPP, minus your tax, minus 10,000. That's what's going to go in your pocket at the end of the day for the year. And then the MPC in this example is going to contribute $13,003. So there's a total contribution in that year of $23,323. It's important to note here that there's going to be a pension adjustment that kicks out of this. So you can't do that $23,000 contribution into HOOPP and do $30,000 a year into, into your RSP. So it's going to grind down. In this case, it would grind down the majority or all of your RSP rooms. So you can't do both is the comment here.
And the portion that the physician contributes personally is tax deductible like an RSP.
Yep, tax deductible like an RSP. Yep, and we can build that into your payroll so you're not paying tax on it.
And the portion that the MPC is putting in, that's a 100% tax deductible expense to the corporation.
Correct.
Okay.
Yeah. Yep. Essentially. Yeah.
Good.
So if you want to flip forward, so one of the things I just wanted to highlight is, it's very different from like an RSP where you put your money in and maybe you manage it and you just do a certain investment and that's what you stick with, or you have an advisor and they manage it and you don't really have to do much. There are administrative requirements with doing HOOPP. I do think they've done a good job of sort of lessening them in a physician situation, but there's annual reporting requirements. HOOPP itself has a website for employers called Insight. You have to log in, you have to report that. When I do the reporting for the clients I work with, I'm doing that actually monthly. So I have to log in every month and I have to report they have 6 to 7 staff at any given point, and I'm reporting that month's salary so we can do the HOOPP calculation, and I'm remitting it on a monthly basis. My understanding with HOOPP is that there's probably for physicians going to be an opportunity to just do that once a year in terms of payments, but there's still annual reporting requirements. So you'll have to do that. There's obviously a payment requirement. You have to pay those amount that 23,000 has to get to HOOPP. So, and as your accountant, I can't make your payments for you. So you're going to have to make sure that happens. If you have staff, there is some complexity. The calculations are slightly different. Then you've got onboarding and offboarding. So you bring someone on, you got to make sure that all their details, there's very specific information that has to go into HOOPP. And then you have to offboard them if they leave. So if they go on a maternity leave or a parental leave, or they quit, there's some offboarding and some reporting that has to happen when they offboard. There's T4 implications. So if you do your T4s yourself, you've got to do your HOOPP reporting first so that you can get that pension adjustment. So your T4 is going to have a pension adjustment on it. You've got to get that onto your T4s when you're filing. The buybacks I'm commenting on here are not around buybacks where you first join and you can buy back, but more if you were to take a leave. So you or your staff were to take a leave and, maybe a parental leave or, a health leave or something like that. There is an option to do a buyback when you're off, but that's a different calculation. It's done slightly differently. That has to get calculated and deducted as well properly. And then the last comment I had on here is just making sure, sometimes I have clients that, you'll forget your payroll remit. Like, and I told Rick, like shoemaker's kids, I've done it. I've forgotten my January 15th payroll remittances. Shoemaker's kids have no shoes, right? Just because I set up the year and I forgot to do January. And so I've had it happen. We can, as your accountant, we can work with you to fix that or to balance it out. You're going to be limited in HOOPP on doing that because you really have to make sure you've paid yourself the appropriate salary, your baseline salary so it's going to make it a little bit harder if you're bad at administration to fix things and avoid sort of maybe penalties for late payments on payroll remittances and things like that. So all things that, and I'm not selling necessarily selling my services here, but if you rely on your service providers to help, they really have to be up to date on this and helping you make sure that there are no mistakes in this going forward. Yeah.
So it sounds to me, Cara, as though for physicians who join HOOPP, the relationship with their accountant is going to get much deeper
Yeah.
through the involvement of HOOPP. And of course, that comes with implications on professional services fees and so forth that are also part of the, due to the accounting firm, all the extra hours they're putting in.
Yep. Yeah, and you can make your account, like I'm the administrator for one of our clients, so I go in and I mean, I can't do the payments, but I can go in and help do the reporting. You can do that. But yes, you're gonna looking at hiring someone to help with that if you aren't comfortable doing it yourself.
Well, and my experience with many physicians is that they don't have, after the demands of their career in a given day, they don't have the interest, the bandwidth, and maybe not the aptitude to really be on note with the requirements of HOOPP. And so having a partnership with an accounting firm who's going to steward you through that would be an important, I think, important consideration. Okay, so there are some administrative details that are kind of hidden away, hidden out of sight, that just come part and parcel with joining any pension plan. This is not a advocating against HOOPP, but just any pension plan. There's a new level of complexity and compliance to make sure you're still in good standing. In addition to the algorithm of figuring out, is this the right move for you, is the question of financial flexibility. Do you value having the ability, whether it's pre-retirement or post-retirement, to have more flexibility in the level of income you draw, the treatment of the money that you save from a tax standpoint, because there are different vehicles treated in different ways, the ability just to orchestrate or to adjust your savings rate accordingly to fit your lifestyle. And so we had talked about, how many physicians that we would talk to in the course of our practices who would aspire towards helping their kids buy their first home, helping with the first, with education costs, taking travel, making trips either before retirement or after retirement. And the ability to have resources that are easily accessible is something that's valued. They won't say it in that way, but practically they kind of accept that there's some liquidity there. And we know that when money goes into any pension plan, it is there until retirement time.
Mm-hmm.
Right? And so it's locked away, not accessible. And so that's part of the consideration of joining HOOPP, is that a portion of what your normal savings rate would be locked away, inaccessible for early retrieval or perhaps flexible retrieval once you reach that retirement threshold and turn the chapter into that next chapter of life. And finally, the last comment I'd make is that HOOPP is not a silver bullet. What do I mean by that? Well, I think Cara and I would both attest to the fact that most of the physicians that we speak to, they look forward to pre-retirement as well as post-retirement, to being able to do things in life that, quite frankly, many other people can't do. There's nothing wrong with that. It's just there's a reward that comes with being a physician that is designed to be commensurate with the costs, the sacrifices that are made, and the responsibilities that are taken on. And so for most people, oh, sorry, I jumped the gun here. When we talk about the income stream that's going to come from the HOOPP pension, there's we want to give you an idea, some samples of what a member in Hoop could look forward to. So we had mentioned in the early going that the Hoop pension, the annual Hoop pension, is a predetermined calculation. 3 factors. One is years of service. 2, the second one is your average earnings, and that's broken up into 2 components. One is the amount, up to the YMPE, which this year is 71,000 and change. And then that's one calculation. And then another calculation on the amount of your average salary over that YMPE. And then the third component is the percentage rate you see on the far right of the slide. So if we were calculating your predicted Hoop pension, we would say number of years service times average earnings up to YMP. Assume that you've taken it all, up to the YMP, $71,300 times 1.5%. And if you've taken more, you get 2% of that excess. And so that allows us to move to a couple of case studies. And we'll visit Dr. Jones, who's enrolled in Hoop and drawing 130,000 in salary. And Cara, do you want to take us through this?
Yeah, so the calculation is just coming from the previous slide, right? So we're assuming she's done 32 years, fully contributing each year within that. I mentioned that little band. So you have your base salary and then you have to contribute within the band. So as long as she's done that, she'll get credit for all of the years that she's there. If you drop below the band, you're gonna see that 32 years drop down as well. So we can't move your salary outside of the band and then still get a full year credit. So it will reduce it. So in this case, this 32 years times that calculation. She's going to have a 7. And again, this ignores any, CPI indexing, all that thing. We're still assuming 71,000 stays the same.
Super simple.
Super simple. Yeah. We like math, don't want to make it complicated. So she's going to get about $72,000 a year in annual pension, assuming she does this for using today dollars at 32 years.
And so that's someone who's fairly young, probably about 32, 33 years old, drawing 130,000 in salary. And we want to compare that to maybe a physician who's a little bit older and getting a little bit later start with Hoop.
Yeah. So in this case, it was just an 18-year calculation. So same taking 150,000. So, trying to make up maybe for less years by doing more runway at the start. So the similar calculation at just under $48,000 a year. So you can see that baseline calculation really has a big impact, as well as the biggest factor in all this is how many years you can contribute. Right. So, and if you're going to do a buyback, that will get you some of those years. But keep in mind, and we talked about this before, if you do a buyback, you may need to move RRSPs over to Hoop as part of that. And it could be significant. It could be $200,000 to $300,000 to $400,000+. So these RRSPs that you have sitting here will move into the Hoop plan. Hoop itself will do the calculation for you. We can't do that. You'll have to give them that information. They'll come back and say, if you want to buy X number of years, this is what you need to do. So you need to come up with that funding to do that. It either needs to be in your RSPs or somewhere else to come from.
Right. So you can see, as Cara has said, the variables, when you tweak those variables, you'd want to look at your own situation and see, what is my runway? What is my salary history? What is it? What am I used to, and what's possible? So as we kind of land this plane, speaking of runways, kind of land this plane, for most physicians, in our experience, the Hoop income, pension income alone, would be insufficient to fund the type of lifestyle that most physicians we deal with would aspire towards in retirement. And so it becomes part of a bigger puzzle rather than the silver bullet. The contributions, as Cara has explained, the contributions you make impact where you can save and how you can save in other areas, how your savings rate is used. Also, from a financial planning standpoint, we're huge advocates of having diversification in the different income sources that you have at retirement. So whether we've got some pension capability, which is inflexible once it starts, RSP and RIF capability in like completely flexible money, tax-free savings account, money saved inside corporations can be very effective. Some of these it gives you that flexibility of income, and it can come from both traditional sources, like I've mentioned, or non-traditional sources. So many physicians are using financial instruments that you would never really think of as retirement tools, but they turn out to be very, very effective given the right circumstances. I want to speak a moment about the question around, I'm a young physician, should I incorporate? And the answer is we don't know. But it used to be very, very common. Once upon a time, if you had an MPC, you could make your children shareholders of the corporation, have them receive dividends at time of post-secondary education. So the corporation is basically funding your children's education. It's called dividend sprinkling. 2016, that went by the boards. And so physicians are more often now, should I even incorporate? This would be an argument for incorporation if HOOPP fit your infrastructure, your financial ecosystem, both for now and in the future. And also, we believe as a firm that your corporation can be an enormous asset in building wealth, because unlike some other types of traditional investments, it allows you to have increased flexibility in how you draw out pre-retirement or post-retirement income. And meanwhile, you can have investments continue on and come in and on corporate tax dollars at 12%, rather than our personal tax dollars, which might be 50%. It just gives you more flexibility in the future. So that's something to be discussed with an accountant, with a financial advisor, to see if incorporation is right for you. And if it is, when. Yeah. You had a comment earlier when we were speaking about young physicians, and maybe they're feeling the need to jump into incorporation, but
yeah, so what I said is it's worth the conversation, right? So with any of my clients, I always have the conversation, and usually I'm updating the conversation every 2 to 3 years and writing it down, and I'll follow up. But I would say in situations where we would have incorporated a physician, 10 years ago, we're waiting. Sometimes we're waiting, right? Especially if you've got significant debt and you want to get that paid down, we're waiting. And if someone tells you that you should just do it without the conversation, it's probably not the right answer. You should at least have a conversation to decide. Having said that, where I might have had a physician before that I wouldn't incorporate, or we would wait, we might do it because of the HOOPP ability.
Just the ability to rack up those years of service.
Yeah.
So the question about whether or not you should enroll in HOOPP, just in wrap up, is not an easy answer. It is a very individual consideration, as we hope you've picked up through our conversation over the last 40 minutes. And we would recommend, our recommendation that you can call a recommendation, is that any decision like this should be made in consultation with your financial advisor, your accountant. If you don't have a financial advisor or a trusted accountant, we're available to be reached. In a moment, you'll be able to see our contact information if you have questions. But seek financial counsel on this, because it is an important decision, and it has long-term implications, because once you're into HOOPP, you're not leaving it.
So you can leave. My understanding is you can leave, but it's significantly going to cut back on what you're going to get out of it in the end, right?
Yes.
You're not going to get all those years of service. It's going to be to me, once you're sort of committed to it, it is a good way of forced retirement savings, but you need to be in it for the long haul to really get your dollars back on this one.
You want to be in it for the long run. So we've reached a point in our in our conversation where we would open the, we're going to go to Jake and see if there are any questions from our attendees.
So the first question is HOOPP committed to climate responsible investing? Is participating in HOOPP tantamount to being complicit with, supporting morally and environmentally objectionable companies?
That's a great question for HOOPP. Yeah, so if you're interested in HOOPP, I mean, my understanding, I haven't looked at the financial statements of HOOPP. I would think that the financial statements would be available publicly. You can go and look in terms of what kind of investments are inside of that. HOOPP itself is a large pension plan. It's probably itself, I mean, you can talk probably quite diversified in terms of many different kinds of assets that it owns. It's got enough money that it can just buy things that, you know, you probably can't buy in your RSP. So you'd have to look at that. That's a great question for them, right? So if you are interested in this plan, you do have a consultation call. It's a question I would put to them for sure.
Yeah, that's a great point because there is the first early step of joining HOOPP. Before you join is you have that consultation call with a HOOPP representative. They'd be able to answer that in more detail. However, I will say that they do advertise as a marketing, as part of their marketing piece, the diversification globally of their investments. And I wouldn't want to speak for their adherence to ESG or SRI type of considerations. And so we'll have you save that question for them.
Okay, our second question is, if future full-time employees are family members, do they need to be brought into HOOPP or are they exempt?
They're always family members of the physician owner are not allowed to join HOOPP. So it's not a choice. They cannot join. Is there an option to stop paying into HOOPP prior to retirement? Sorry, this is all part of the same question. Yeah, so so again, I learn more about this every week in terms of the physician rules are a little bit different than a regular employee. My understanding is yes, you can leave. You can basically stop paying yourself a salary, but you have to deregister with HOOPP, and you're not going to get that first part of that calculation where it's all those eligible years. You won't have very many. Is there a definition of retirement based on number of hours worked? Does reducing it by half count? So what'll happen so say you set your baseline at $100,000 as an example, and then you decide, you know what, I only want a salary of $40,000 a year going forward. What will happen is there's a calculation that happens. You will still contribute to HOOPP sort of based on that 40,000. It's not exactly equal to 6.9%. It's a bit more, but you're also going to drop your year. You're not going to get a full year of contribution in that first part of the calculation. There is some example. So one thing that HOOPP is going to come out with, there's an online calculator to do those calculations. My understanding is if they'll give it to you once you sort of done the call, but it will be available to the administrators in May. So we'll be able to run some math with that to say, you know, if you drop from 100 to 40, this is what your contributions will be. And this is how much, instead of getting a whole year, you're only going to get, you know, once or a sixth of a year as an example, or
Now, and I interpret that question a little bit different.
Oh, sorry.
No, but I may be very, very wrong on this, but I think it's worth mentioning that you know, we talk about the number of people today who are taking non-traditional retirement, which has now become more traditional retirement, of tapering. Right. So we've been going full bore, pedal to the metal for a number of years. We hit a certain age, and as long as that age is over age 55, as long as that age over age 55, you can trigger your pension with HOOPP. You would start to draw your pension. You'd make no further contributions to it. And they are really disinterested in whether or not maybe you've gone to a 3-day work week or so on. Yeah. You trigger the retirement event as long as it's after age 55. Yeah. And in the hours I don't think matter, right? So as long as you're paying yourself that baseline salary, even if you've cut your hours back, so you're not drawing HOOPP, but you're still working and you're still taking a salary, it doesn't matter if you're gone to
halftime or.
Yeah,
That
so
makes
there's flexibility there.
Yeah.
Over 55. You're at a point where you're eligible to start drawing whenever you want. But you could keep working, like
Yep.
Cara said, you could reduce your number of days in the office, but you'd still be kind of responsible to hit
Yeah.
within those boundaries of your salary level.
How much can you still draw as dividends? Could you draw 80K in salary and base HOOPP on that, and then also pay yourself 80K in dividends?
Yep. Yep. So when you set your baseline, so that's a really good question, actually. So you set your baseline. So if you decide I want my baseline calculation, which is that 6.9 and that 9.2, my understanding is you can set that at say 80, and you can still pay yourself a salary of 200 if you want. So you actually have flexibility. You're just setting the baseline for HOOPP calculations. And then going forward, you always have to pay within the band, the salary, but you can pay yourself a salary above that 80 if you want to, or you can do dividends above that 80 if you want to. Yeah.
And there's no restriction. You could have 80,000 of salary, you could have 300,000 of dividend if you want. There's no, it's not that there's no ratio that has to be maintained. And where salary comes in most often is get it to YMP, so you have full CPP contributions through your career. And anything over that, you're creating RSP contribution room. And then as we've been talking about throughout the last while, you're setting your financial obligation towards the HOOPP pension plan with how much of your overall income is denoted as salary.
And you're not stuck with one decision or another, right? So if you want to do RSP max, which is like 187, but you want to do your HOOPP contributions on 80, you can do that. You can do your HOOPP contributions on 80, you can contribute, and then you can still build RSP room separate to that. Like it's going to grind some of your room, it'll use up some of your room, but you can still do both.
You just can't do it the other way around. You can't take 80 and claim that and make payments on 100 on 180.
Yeah, exactly.
Thanks for the informative session. It sounds like part of the decision making is, am I going to stay in Ontario until retirement?
Ooh.
Really good question.
Yeah. So you will get years of service for the years you contribute, right? So if you stay in Ontario for 10 years and they've got a calculation, you'll get 10 years of service. So you'll have a reduced pension because you've left the province now and you're working somewhere else. So but once you're out of Ontario, you're not contributing to HOOPP anymore. So
right on.
I don't know if it stops me from if the right decision for you is that you should have a pension because you want to save there and have that have that option as an option for you. I don't know if it changes it. It means your Ontario HOOPP pension will be lower in retirement, which means when you move to another province who may or may not have a similar thing, you're gonna have to save elsewhere.
Yeah. So really what you're doing when you leave Ontario, you're stopping your contributions to HOOPP. You're locking in your years of service piece of the formula or pension, years of contributions. You're locking that in and we're kind of freezing in many ways. You're freezing that pension. And, I believe BC is a province that has a pension plan for positions.
And I bet if they all start offering, like if the other provinces follow along, there may be an ability to move that pension over and get years of services Ontario credited there.
Yes.
That may happen. I'm making that up now because it hasn't happened yet.
But when you are a member of a pension plan where you have the right to commute the value, take the cash value of the pension rather than income, that goes into a locked in retirement account.
Yeah.
And then you have the ability to use those values in a locked in retirement account to fund buyback someplace else in a new pension plan.
But if you're making the decision on whether to incorporate to do this, I always tell clients, if you're going to move within a couple of years, you may want to delay incorporation in Ontario because you're just going to have to do it over or move your corp to the new province. So it's all factors. How long are you incorporated already? Should you incorporate?
So our final question is, can you please go over how HOOPP affects RRSP contributions?
Yes. So essentially the math, if you do, so say you're taking a salary from from your MPC. So say you set your baseline at the RSP max, which is like 187,000. If you run of salary.
Of salary.
Of
yes,
salary.
Yeah.
So say you set it at 187,000. So 187,000 is going to get you about $32,000 of RSP room. Okay. If you set your HOOPP baseline at 187, that is basically going to use up all of your RSP room. You're not, when you add together your 6.9 and your 9.2, and then your corporation's 126. So that the pension adjustment is those three things together. Plus there's usually some kind of like return built into that as well. That's going to use up all, if not more than your $32,000 of RSP room. It might be more. You might have a pension adjustment of 34,000, which means that if you have historical RSP room, it's going to grind that down too. You can end up in a negative. Like if it's done through a pension plan, you can end up with a negative RSP contribution. That's okay. It just means you're never going to be able to do your RSP ever, essentially, because you're going to be starting at a negative and it's going to get more and more negative, if that makes sense. So that's why you have to think about this baseline, right? Am I going to go all the way to max, or do I want flexibility?
Okay. So Jake, if you could take us to the final slide, and it gives us contact coordinates for both Cara and myself. And Cara, I want to thank you on behalf of all the attendees and on behalf of Caldwell Wealth and State Advisory for accepting our invitation. Cara and I share a lot of joint clients, and it was very important to us to have a trusted colleague sitting in the chair beside who we have a lot of confidence in the way we get to see how she serves her clients and the depth of her knowledge. And we hope that came through. If we can be of any help at all, answering questions, you're going to be receiving, actually, people who are registered for this webinar are going to be receiving an email in the next 30 minutes or so, thanking you, first of all, for participating in our call today, and also giving you an opportunity for some feedback. And part of the feedback is whether or not you would like one of us or both of us, our firms, to contact you for any support that we can provide. So please make that available to yourselves. And with that, I think, Jake, thank you very much for your support behind the scenes. And Cara, again, thank you for taking time out of your evening and being part of our time together. And so thank you very much, and good night.
Yeah, thank you.